Before any great investor builds wealth, before any portfolio grows, before any dream of financial freedom becomes real, there is a moment of confusion, a moment where the world of money feels loud, chaotic, and impossible to understand. Everywhere you look, people are chasing the next hot stock, reacting to headlines, or trying to predict what the market will do tomorrow. One person says buy, another says sell. Fear and excitement move faster than logic. And in the middle of all that noise, most people lose sight of the one thing that truly matters: building a strategy that can survive time. That is where this journey begins. All About Asset Allocation is not a book about getting rich overnight. It is about building wealth with intelligence, patience, and clarity. Richard Ferri teaches us something that many investors spend years learning the hard way. Success in investing is not determined by luck, predictions, or constantly chasing opportunities. It is determined by how wisely you divide your money, manage risk, and stay disciplined when emotions try to take control. Think of investing like building a ship before crossing a vast ocean. Most people obsess over speed, but experienced sailors focus first on balance, structure, and stability. Because when storms arrive, and they always do, the strongest ship survives while reckless ones collapse. Asset allocation is that structure. It is the hidden framework that protects wealth during uncertainty and allows it to grow steadily over decades. In the chapters ahead, you will discover how stocks, bonds, cash, real estate, and international investments each play a different role in your financial life. You will learn why diversification is more powerful than prediction, why time is the greatest advantage an investor can have, and why mastering your emotions is often more important than mastering the market itself. This is not just about numbers. It is about building confidence. It is about creating a portfolio that allows you to sleep peacefully at night while your money quietly works in the background. And before we explore advanced strategies, complex portfolios, or market psychology, we must begin with the foundation. Because every successful investment journey starts with one simple but life-changing question: how should you divide your money wisely? That is exactly where Chapter 1 begins. Chapter 1: Asset Allocation Basics. Let us start with the most important question any investor can ask. Not, which stock should I buy? Not, when should I sell? But this: how should I divide my money? That question, simple as it sounds, is the heart of asset allocation. At its core, asset allocation means spreading your money across different categories of investments, called asset classes. Think of stocks, bonds, and cash as three different rooms in a house. Each room serves a different purpose. Each has its own temperature. And how much time you spend in each room determines how comfortable your financial life will be. Here is where most beginners make mistakes. They put all their money in one room. They buy only stocks because stocks feel exciting, or they keep everything in cash because cash feels safe. But a single room strategy leaves you exposed. Too much heat in summer, too much cold in winter. Asset allocation says, use all the rooms wisely. Now, here is a key insight that Ferri builds his entire book around. Research shows, and this is not just opinion, it is backed by decades of data, that roughly 90% of a portfolio's long-term performance comes from how you allocate across asset classes, not from which individual stocks or funds you pick within those classes. Read that again. 90%. The specific stock you pick matters far less than the category of investment you choose and how much you put into it. Imagine two investors. The first spends hours every week researching individual companies, trying to find the next big winner. The second spends one afternoon deciding the right mix of stocks, bonds, and real estate, and then barely touches it for years. History suggests the second investor is likely to come out ahead. This is why this matters in real investing. Asset allocation is not glamorous. It will never trend on social media. No one brags at a dinner party about their well-diversified bond allocation, but it is the quiet engine behind almost every wealth-building success story you have ever heard. Now, how do you actually decide your allocation? Ferri explains that it comes down to three core factors: your goals, your time horizon, and your risk tolerance. Your goals tell you where you want to go. Are you saving for retirement in 30 years? A house in 5? Your child's education in 10? Each goal needs a different kind of fuel. Your time horizon tells you how long you have to get there. A longer runway gives you more room to take risk and recover from losses. A shorter runway means you need more stability. Your risk tolerance tells you how much turbulence you can handle emotionally and financially without jumping off the plane. This is more psychological than mathematical, and Ferri is honest about that. Knowing your own emotional response to loss is just as important as knowing your financial situation. If you are starting today, begin by writing down your top 2 or 3 financial goals. Assign a rough time frame to each. Then ask yourself honestly, if my investments dropped by 30% tomorrow, would I panic and sell, or would I hold steady? Your answers to these questions are the foundation of your allocation plan. Let us also talk about rebalancing just briefly here, because Ferri introduces it early. Over time, different parts of your portfolio will grow at different speeds. Stocks might surge and become a much larger piece of your portfolio than you planned. Bonds might lag. Rebalancing means trimming what grew too large and adding to what shrunk, bringing everything back to your original plan. It is discipline in action. Picture a gardener who tends a garden not just by planting seeds, but by trimming what overgrows and nurturing what struggles. That is what a good investor does with allocation. This chapter lays the entire foundation. Everything that follows, every asset class, every strategy, every advanced concept builds on this single idea. Decide how to divide your money wisely, based on your goals, time, and tolerance for risk. Then commit to that plan. And speaking of risk, you might be wondering, what exactly is risk? And why does it feel so different from what textbooks describe? That is exactly where we are heading next. Chapter 2. Risk and Return. Every investor has heard the phrase, higher risk, higher return. It gets repeated so often that it starts to feel like a financial law of nature, like gravity. But here is the truth that most beginner investors never get taught. Risk and return are not a guarantee. They are a relationship. And like all relationships, they are complicated. Let us start with what risk actually means in investing. Risk, in the world of asset allocation, is primarily about volatility. That is how much the value of an investment moves up and down over time. A stock that doubles in value one year and loses half its value the next is highly volatile, meaning highly risky. A government bond that grows slowly and steadily year after year is far less volatile, meaning far less risky. But here is where the story gets interesting. Volatility is not the only kind of risk. Ferri teaches that investors face multiple layers of risk, and ignoring any of them is a mistake. There is market risk, the chance that the overall market falls and drags your investment down with it. There is inflation risk, the quiet danger that your money grows too slowly and loses purchasing power over time. $1,000 today might not buy what $1,000 buys 20 years from now. There is concentration risk, the danger of putting too much into one type of investment or one company. And there is behavioral risk, perhaps the most dangerous of all, which is the risk that your own emotions make you buy high and sell low. This is where most beginners make mistakes. They fear the wrong risks. They obsess over short-term market drops, which are normal and temporary, while ignoring inflation risk, which slowly erodes their savings over decades without making a single headline. Imagine a family who keeps all their savings in a regular bank account, feeling safe and secure. Over 20 years, inflation quietly eats away at the purchasing power of their money. They did not lose money on paper, but they lost ground in real life. That is inflation risk in action. It is invisible, but it is very real. Now, return. What does return really mean? Return is the reward you receive for taking on risk and for being patient. Ferri is careful to explain that returns from different asset classes come from very different sources. Stock returns come from the growth of companies and the profits they generate. Bond returns come from interest payments over time. Real estate returns come from rental income and property value appreciation. Each source of return has its own rhythm and its own risk profile. And understanding this is essential for building a portfolio that makes sense for your life. Here is a practical truth. Over long periods, stocks have historically delivered the highest returns among major asset classes. But they have also swung wildly along the way. Bonds have delivered lower but steadier returns. Cash has delivered the lowest returns of all, barely outpacing inflation in many environments. The investor who wants only safety will likely end up too poor in retirement. The investor who wants only maximum return will likely panic and sell at the worst moment. The wise investor finds the balance between the two based on their specific goals and time horizon. If you are starting today, try this mental exercise. For every investment you consider, ask two questions. First, what is the potential return and over what time frame? Second, what is the potential loss and could I emotionally and financially survive it without panic? If the answer to the second question makes you uncomfortable, that investment carries more risk than you should take on right now. There is also a concept called the risk premium. This is the extra return that riskier investments have historically provided over safer investments over long periods. Think of it as the emotional and financial price of admission for higher returns. You endure the scary moments so that your portfolio can grow faster over time. Ferri also introduces the idea that risk feels very different depending on your time horizon. A 30% market drop is terrifying if you need that money in 6 months. It is much less frightening if you will not need it for 20 years. Time is the investor's greatest tool for managing risk because markets, historically, have always recovered given enough time. Picture a sailor caught in a storm. If they are close to shore and low on supplies, the storm is a crisis. If they are on a long ocean voyage with plenty of provisions and a sturdy ship, the storm is just weather. Same storm. Completely different experience. That is the power of time horizon in investing. The relationship between risk and return will weave through every chapter in this book. Because every asset class, every strategy, every portfolio decision is ultimately an answer to one question. How much risk are you willing to accept in exchange for the return you desire? And now that we understand risk and return individually, we need to talk about the most powerful tool for managing them together. It is not a product, not a formula, not even a fund. It is a concept called diversification, and it will change the way you see your entire financial life. Chapter 3. Diversification. If there is one concept in all of investing that genuinely works like magic, it is diversification. Not because it eliminates risk. It does not. But because it does something almost miraculous. It reduces risk without reducing your expected return. In the world of finance, that is extraordinarily rare. Let us understand this properly, because most people think they understand diversification but actually only understand half of it. The simple version goes like this. Do not put all your eggs in one basket. Everyone has heard that. And yes, it is true. If you put all your money into a single company and that company collapses, you lose everything. But if you spread your money across 100 companies, the failure of one barely moves the needle. But Ferri goes deeper than the egg basket analogy, and this is where the real insight lives. True diversification is not just about owning many things. It is about owning things that do not move in the same direction at the same time. In investment language, this is called low correlation. Two investments are correlated when they tend to rise and fall together. They are uncorrelated or negatively correlated when they move independently, or even in opposite directions. This is why this matters in real investing. When you combine assets that are not perfectly correlated, you create a portfolio that is smoother, more stable, and more resilient than any individual investment within it. Your overall risk drops without your overall return having to drop with it. That is the genuine magic. Here is a real-world style example to make this vivid. Imagine you own a business that sells ice cream and another business that sells umbrellas. On sunny days, ice cream sales are high, but umbrella sales are slow. On rainy days, umbrella sales surge, but ice cream sales drop. Together, these two businesses create a much steadier income than either one alone. They are negatively correlated, and that negative correlation smooths out your total cash flow. Investing works exactly the same way. Stocks and bonds, for much of financial history, have had relatively low correlation with each other. When stock markets crashed, bonds often held steady or even rose as investors fled to safety. This is why the classic stock and bond portfolio is so powerful. Not because either one is perfect, but because together they reduce each other's worst moments. But here is where most beginners make mistakes. They own 20 stocks and think they are diversified, or they own 5 mutual funds and feel fully protected. But if those 20 stocks are all technology companies, they move together. And if those 5 funds all invest in the same types of assets, they are essentially the same fund wearing different names. True diversification means spreading across different asset classes, different sectors, different geographies, and different time horizons. It means your international stocks and your domestic stocks and your bonds and your real estate investments, each playing a different role in your portfolio, like musicians in an orchestra, each contributing a different sound. Ferri also addresses what he calls diversification across time, and this is a subtle but powerful idea. Rather than investing a lump sum all at once, many investors benefit from investing smaller amounts regularly over time, a strategy known as dollar cost averaging. When markets are high, your regular investment buys fewer shares. When markets are low, it buys more. Over time, this averages out your cost and reduces the risk of investing everything at the worst possible moment. If you are starting today, look at your current investments or savings and ask this question. If a major crisis hit tomorrow, would all of these investments fall together? Or would some hold steady while others dropped? If the answer is that everything would fall together, you are not as diversified as you think. The goal is to build a portfolio where no single event, no recession, no sector collapse, no geographic crisis can wipe you out completely. You want to be the person who weathers the storm, not because you predicted it, but because you were prepared for it. There is also an important psychological layer to diversification that Ferri does not ignore. When you are properly diversified, you are far less likely to panic during a market downturn. Why? Because even in a bad year, some part of your portfolio is doing better than the rest. That visible cushion, that sense that not everything is falling, makes it much easier to stay the course and not make emotional, destructive decisions. Imagine an investor watching the news in the middle of a market crash. They see their stocks down sharply, but their bonds are up. Their international holdings have held relatively steady. They see the damage, yes, but they also see the cushion. And that cushion is the difference between panic and patience. We have now laid the 3 pillars of asset allocation thinking. Deciding how to divide your money, understanding risk and return, and embracing the power of diversification. But there is one more foundational idea before we move into the specific asset classes. And it might be the one that matters most of all. It is the idea of time. And how the length of your journey changes absolutely everything about the way you should invest. Chapter 4. The Importance of Time Horizon. There is an old story about 2 trees in a forest. One is a young sapling, flexible and quick to grow. The other is an ancient oak, deep-rooted and steady. When a storm comes, the sapling bends. The oak does not move. But when the sun returns, the sapling springs back immediately, growing tall and fast. The oak grows slowly but powerfully, year after year after year. Your investment portfolio is a living thing. And like those trees, the amount of time you give it to grow changes everything about how it behaves and how you should treat it. Time horizon is simply the length of time you plan to invest before you need the money. But do not let the simplicity fool you. This single factor shapes almost every decision in your investment life. Here is the fundamental principle that Ferri teaches. The longer your time horizon, the more risk you can afford to take. The shorter your time horizon, the more stability you need. Why? Because risk in investing is largely about volatility, about the stomach-churning ups and downs of markets. And here is the beautiful truth about volatility. Over long enough periods of time, markets have historically recovered from every crash, every recession, every financial crisis that humanity has ever thrown at them. Not immediately, not without pain, but eventually. This is where most beginners make mistakes. They either take too much risk with money they will need soon, or they play it too safe with money they will not need for decades. Both mistakes are costly, just in different ways. Let us walk through a clear example. Imagine 3 investors. The first investor is 25 years old, saving for retirement. They will not touch this money for 40 years. For this investor, a market crash is not a crisis. It is actually an opportunity, a chance to buy more investments at lower prices. They should lean heavily toward higher growth assets like stocks. The second investor is 50 years old, also saving for retirement, but now only 15 years away. They still have time on their side, but less of it. A major market crash at the wrong moment could genuinely set them back. They should have a mix, still some growth through stocks, but more stability through bonds. The third investor is 68 years old, already in retirement, drawing from their portfolio to pay bills. For this investor, a sudden market crash can force them to sell investments at low prices just to cover living expenses. That is a real and lasting harm. This investor needs much more stability, more bonds, more cash equivalents. Same financial markets. Three completely different situations. Three completely different approaches. Time horizon is what separates them. Ferri also introduces a concept that is essential for long-term thinking. He talks about the journey versus the destination. Many investors focus entirely on maximizing returns, always chasing the highest possible number. But Ferri argues that what actually matters is whether you reach your goal. If your goal is to have a certain amount of money at retirement, and a more conservative portfolio gets you there while a more aggressive one leaves you panicking and selling during crashes, the conservative portfolio wins. Not because it was theoretically superior, because you actually stayed with it. This is a profound insight about investor psychology. The best portfolio is not the one that performs best in a spreadsheet. It is the one you can stick with through both rising and falling markets without making fear-based decisions. If you are starting today, the most powerful thing you can do is simply start. Even small investments made consistently over a long time horizon build remarkable wealth through a force called compounding. Compounding is the process where your returns earn their own returns, year after year, growing your wealth at an accelerating pace. The longer the time horizon, the more powerful compounding becomes. Picture a single snowball rolling down a very long hill. At the top, it is tiny. 100 meters down, it is bigger. 1,000 meters down, it is enormous. The snowball is compounding. The hill is time. And the investor who starts early and stays patient is the one who reaches the bottom of the hill with something extraordinary. Time horizon also affects how you think about short-term market noise. When markets drop by 10% over a few weeks, it dominates financial news. It feels catastrophic, but for an investor with a 30-year horizon, a 10% drop is a small ripple in a very long ocean voyage. The ability to zoom out, to see the short-term turbulence in the context of the long-term journey, is one of the most valuable skills any investor can develop. We have now completed the foundation. You understand what asset allocation is, how risk and return work, why diversification is so powerful, and why time is perhaps your greatest investment advantage. Now it is time to move from principles to the building blocks themselves. Because you cannot build a portfolio without understanding what you are building it with. In the next section, we are going into the world of asset classes. One by one, we will explore what they are, how they work, what risks they carry, and what role each one plays in a well-designed portfolio. First stop, the world of stocks. Chapter 5. Stocks. Stocks are the most talked about investment in the world. They are the stars of financial news, the subject of endless debate, and the investment that most people associate with both great wealth and great loss. But what exactly are they, and why do they deserve a central place in most long-term portfolios? At its most basic, a stock represents ownership in a company. When you buy a share of stock, you become a part owner of that business. If the company grows and becomes more profitable, your ownership stake becomes more valuable. If the company struggles or fails, your investment can fall sharply or even become worthless. This ownership dimension is what makes stocks fundamentally different from other investments. You are not lending money to someone and waiting to get it back with interest. You are betting on human ingenuity, business growth, and economic progress. And over long time horizons, that bet has historically paid off very well. Ferri explains that stock returns come from two sources: capital appreciation, meaning the stock price rises as the company becomes more valuable, and dividends, meaning the company shares a portion of its profits directly with shareholders. Both sources of return contribute to stocks being the highest returning major asset class over long periods of time. But here is the trade-off that every stock investor must understand. With the highest long-term returns comes the highest short-term volatility. Stocks can and do fall by 30, 40, even 50% during major market downturns. This is not unusual. It is a feature, not a flaw. Those painful drops are the price of admission for the superior long-term growth. Here is where most beginners make mistakes. They buy stocks when everything feels good and sell when everything feels terrible. They buy high and sell low, which is the exact opposite of what builds wealth. The drops feel like emergencies. They feel permanent. But historically, they have always been temporary. Imagine an investor who put money into a broad stock market fund in early 2009, right as the global financial crisis was still unfolding. The news was devastating. Banks were failing, unemployment was soaring, everything felt broken. But that investor who held on through the fear saw remarkable gains over the following decade as markets recovered and grew to new heights. The ones who sold at the bottom locked in their losses permanently. This is why this matters in real investing. The ability to hold stocks through turbulent periods is not just a nice trait. It is the mechanism by which long-term returns are delivered. You earn the return by tolerating the ride. Ferri also breaks down the different categories of stocks. There are large company stocks and small company stocks. There are growth stocks, which are companies expected to grow rapidly but that often pay little or no dividends, and value stocks, which are companies that appear underpriced relative to their earnings and often pay dividends. There are domestic stocks from your home country and international stocks from companies around the world. Each of these categories has its own return profile and its own risk characteristics. Small company stocks have historically delivered higher long-term returns than large company stocks, but with more volatility along the way. Value stocks have historically outperformed growth stocks over very long periods, though growth stocks had a strong run for many years in recent history. If you are starting today, the single most practical piece of advice for stock investing is this: own everything through broadly diversified index funds. Rather than trying to pick individual winning stocks, which research consistently shows is extremely difficult to do successfully over time, simply own a fund that holds hundreds or thousands of companies across many sectors and geographies. This gives you the full return of the stock market with the safety of extreme diversification. The psychological challenge of stock investing deserves a full moment of attention. Stocks provoke emotion. When they rise, we feel smart and want more. When they fall, we feel foolish and want out. Both instincts are natural. Both instincts are destructive. Successful stock investors learn to treat their investments like a great business they are a part owner of, not like a lottery ticket whose value they check every hour. Picture a farmer who plants seeds in spring. They do not dig up the seeds every few days to see if anything is growing. They do not panic in a drought and pull up the entire crop. They trust the process, manage what they can, and wait patiently for the harvest. Long-term stock investors are farmers. Short-term traders are gamblers. Stocks are the engine of a long-term portfolio. They provide the growth that outpaces inflation and builds real wealth over decades. But no engine runs forever without balance. And in the next chapter, we meet the stabilizer. The investment that has quietly been the foundation of steady, reliable wealth for centuries. Bonds. Chapter 6. Bonds. If stocks are the accelerator of a financial portfolio, bonds are the brake and the shock absorber. They rarely generate the excitement of a surging stock market, and they will never be the subject of breathless financial headlines. But in the quiet, steady work of building and protecting wealth, bonds play a role that no other investment can fully replace. So what exactly is a bond? When you buy a bond, you are lending money, typically to a government or a corporation. In return, that borrower promises to pay you regular interest payments for a set period of time, and then to return your original investment at the end of that period, called the maturity date. It is a formal debt agreement with you as the lender. Governments issue bonds to fund public spending and infrastructure. Corporations issue bonds to fund expansion and operations, and investors who hold these bonds receive a predictable income stream in return for their patience. Ferri explains that bonds serve three critical purposes in a portfolio. First, they provide income through their regular interest payments. Second, they reduce overall portfolio volatility because bond prices tend to be more stable than stock prices. Third, they often rise in value during stock market downturns, providing a cushion exactly when you need it most. This is why this matters in real investing. In the years when stock markets fall sharply, the bond portion of a well-allocated portfolio often rises or holds steady. That stability is not just comforting emotionally, it is financially powerful because it means you have assets you can sell at good prices to cover expenses, rather than being forced to sell fallen stocks at a loss. There are several types of bonds that Ferri walks through, and understanding the differences is important. Government bonds, especially from stable countries, are considered among the safest investments in the world. They carry very low credit risk, meaning the likelihood of not getting paid back is extremely small. In exchange for that safety, they offer relatively lower interest rates than riskier options. Corporate bonds offer higher interest rates than government bonds because they carry more risk. If a company runs into financial trouble, it might struggle to make its interest payments or repay its bondholders. The higher the risk of the company, the higher the interest rate it must offer to attract lenders. Municipal bonds are issued by local and regional governments for specific projects like roads, schools, and hospitals. They often carry tax advantages that make them especially attractive to investors in higher tax situations. Inflation-protected bonds are a special category designed to protect investors from the quiet threat of inflation. Their value adjusts with inflation, ensuring that your purchasing power is preserved over time. Here is where most beginners make mistakes with bonds. They assume that because bonds are safer than stocks, they carry no real risk. But bonds have their own unique risks, and ignoring them is dangerous. The most important of these is interest rate risk. When interest rates rise, the value of existing bonds falls. This is because new bonds being issued pay higher interest, making the older, lower-paying bonds less attractive. If you need to sell a bond before it matures and interest rates have risen since you bought it, you could receive less than you paid. Imagine buying a bond that pays you a fixed amount each year. Then, a year later, new bonds are offered that pay twice as much. Suddenly, your bond looks much less attractive. Its market value drops to reflect that lower payment. This is interest rate risk, and it is very real, especially in environments where interest rates are rising. The practical application here is about matching your bond choices to your time horizon and your income needs. Shorter-term bonds carry less interest rate risk. Longer-term bonds carry more, but typically offer higher rates in exchange. Ferri guides readers toward understanding their own situation before choosing which type of bonds belong in their portfolio. If you are starting today, a simple approach is to include a broadly diversified bond index fund in your portfolio alongside your stock fund. How much to put in bonds versus stocks depends on your time horizon and risk tolerance, topics we discussed in the foundation chapters. A younger investor might hold mostly stocks with a smaller bond allocation. An older investor nearing or in retirement might hold much more in bonds for stability. Picture a couple nearing retirement who had always invested entirely in stocks. When a sudden market crash hit, they watched their portfolio drop dramatically. But they had gradually shifted a larger portion into bonds over the prior decade. Those bonds barely moved, and that stability gave them the confidence and the financial ability to hold their remaining stocks through the recovery rather than selling in panic. Their bond allocation was not exciting. It was essential. Bonds are not the most thrilling topic in investing, but the investors who understand them and use them well sleep better, make fewer panicked decisions, and often reach their financial goals with far less emotional suffering along the way. Having covered the two major pillars of most portfolios, stocks and bonds, there is a third category that often gets overlooked or underestimated. It is the most stable of all, but also carries its own hidden risk. It is cash. Chapter 7. Cash Investments. The word cash in investing does not just mean paper bills in your wallet. It refers to a category of very short-term, very stable investments that function like cash. Savings accounts, money market funds, treasury bills, and certificates of deposit are all examples of cash investments. These are the investments where your principal is most stable, where you are least likely to open your account statement and see a number smaller than what you put in. For many people, that stability is deeply reassuring. But Ferri is honest about the hidden danger of cash. And it is important to hear this clearly. The danger of holding too much cash for too long is inflation. Over time, inflation steadily erodes the purchasing power of money that sits still. If inflation grows faster than the interest your cash is earning, you are actually losing ground in real terms, even while your balance looks like it is growing on paper. This is where most beginners make mistakes. They hold too much cash because it feels safe. They see their account balance never dropping and they feel protected. But they are not accounting for the slow, invisible tax of inflation steadily eating away at what their money can actually buy. Imagine a family that kept a significant portion of their long-term savings in a low-interest savings account for 20 years. On paper, their balance grew slightly each year. But when they finally went to use it, they discovered that the things they wanted to buy, a comfortable retirement, travel, their children's education, had all become far more expensive. Their money had grown less than the cost of living. In real purchasing power terms, they had moved backwards. This is why this matters in real investing. Cash is not a long-term wealth-building tool. It is a short-term parking place. So what is cash good for? Several things, actually. First, cash is essential as an emergency fund. Most financial advisors, Ferri included, recommend keeping 3 to 6 months of living expenses in accessible, stable cash accounts. This emergency buffer means that if something goes wrong, a job loss, an unexpected medical expense, a major home repair, you do not have to sell your investments at a bad moment to cover the cost. Second, cash serves a specific role within a portfolio as a place to park money you will need in the near term. If you know you will need to use a portion of your investment money within the next year or two, that portion should be in something stable, like cash or short-term bonds, not in stocks that could drop sharply right before you need to access them. Third, cash can serve as dry powder. A small allocation to cash gives an investor flexibility to deploy money into the market when opportunities arise, without having to sell other investments first. If you are starting today, make sure your emergency fund is fully funded in a safe, accessible account before you invest a single dollar in the markets. That buffer is your financial foundation. Without it, a single unexpected event can force you to disrupt your investment plan at the worst possible moment. The psychological comfort of cash is real and should not be entirely dismissed. Knowing that a portion of your money is completely stable can give you the emotional steadiness to keep your riskier investments in place during volatile markets. That psychological role has genuine practical value, but keep that cash allocation appropriate. Too little cash and you are vulnerable to short-term disruptions. Too much cash and you are sacrificing the long-term growth that protects you from the slow erosion of inflation. Picture cash as the anchor of a ship. An anchor keeps the ship from drifting dangerously in a storm. It is essential, but a ship that never leaves port, that spends all its time anchored, never goes anywhere. The anchor is not the journey. It is the safety mechanism that makes the journey possible. We have now walked through the 3 core asset classes that form the foundation of most portfolios: stocks for growth, bonds for stability and income, and cash for safety and short-term needs. But a truly diversified portfolio can reach beyond these 3 into other asset classes that provide unique benefits and additional diversification. Up next, we explore the world of real estate, an investment that surrounds us in everyday life but operates on rules entirely its own. Chapter 8. Real Estate Investments. There is something primal about real estate. Land, buildings, physical spaces. Unlike a stock or a bond, you can touch real estate. You can walk through it. You can see it standing there, solid and permanent. And that tangible quality gives many investors a level of comfort that paper investments simply cannot match. But Ferri approaches real estate with the same disciplined, analytical eye he brings to every asset class. Because whether an investment feels good is far less important than whether it actually serves your portfolio's needs. Real estate as an investment comes in 2 main forms for most individual investors: direct ownership, which means actually buying property like a rental home or an apartment building, and indirect ownership through a vehicle called a real estate investment trust, commonly abbreviated as a REIT and pronounced like the word REIT. Direct real estate ownership is what most people think of when they hear the phrase investing in real estate. You buy a property, perhaps rent it out to tenants, collect rental income, and benefit from the property's appreciation in value over time. Many people have built genuine wealth this way, and it can be a powerful strategy for the right type of investor. But Ferri is careful to highlight that direct real estate ownership comes with significant responsibilities and risks that are often underestimated. Properties need maintenance. Tenants do not always pay on time. Markets can go through long periods where property values stagnate or fall. And unlike a stock in a diversified fund, a single rental property is extremely concentrated. All of your real estate exposure is in one building, in one neighborhood, subject to one local market's conditions. This is where REITs become incredibly powerful for most investors. A real estate investment trust is essentially a company that owns and manages a large portfolio of income-producing real estate properties. By buying shares of a REIT, you gain exposure to real estate returns without having to buy, manage, or maintain any physical property yourself. REITs are required by law to distribute a large majority of their taxable income to shareholders as dividends, which makes them excellent sources of regular income. REITs can own many different types of real estate. Office buildings, shopping centers, apartment complexes, hospitals, data centers, warehouse facilities, and self-storage units are all examples of real estate that large REITs manage. This built-in diversification across property types and geographies reduces the concentration risk of owning a single property. This is where most beginners make mistakes with real estate. They either avoid it entirely because direct ownership seems too complicated, missing out on real estate's diversification benefits, or they invest everything in a single property or a small number of properties, taking on extreme concentration risk without realizing it. Here is why real estate earns a place in a well-diversified portfolio. Real estate returns have historically had relatively low correlation with stock and bond returns. In other words, real estate does not always move in the same direction as stocks or bonds. Adding it to a portfolio can therefore smooth out overall volatility and improve the risk-adjusted return of the whole. Real estate also provides a degree of inflation protection that many investors find valuable. When inflation rises, the cost of building new properties rises, which tends to support the value of existing properties. Rental income also tends to rise with inflation over time, providing a natural hedge against the eroding power of rising prices. Imagine a retiree who holds a portion of their portfolio in a REIT fund. Even during periods when stocks are struggling, the REIT continues generating dividend income from the rent payments of thousands of tenants across dozens of property types. That income flows in regardless of what stock markets are doing, providing both financial stability and psychological comfort. If you are starting today, the most practical approach to adding real estate to your portfolio is through a low-cost REIT index fund. This gives you broad, diversified exposure to real estate markets across the country or even globally, with no maintenance headaches, no tenant management, and no concentration in a single property. How much of your portfolio should be in real estate? Ferri suggests that a meaningful but not dominant allocation, somewhere in the range of 5 to 15% of your total portfolio, can add genuine diversification without making your portfolio overly dependent on one sector. Picture an orchestra where real estate is one of the wind instruments, not the loudest instrument, not the one carrying the main melody, but essential for depth, for texture, for the richness that makes the music whole. Remove it, and something important is missing. Overplay it, and it drowns out everything else. Real estate adds a dimension to a portfolio that stocks and bonds alone cannot provide. But just as important as what you own is how all the pieces fit together. And we are not done expanding our asset class toolkit. Our next stop takes us into a world that most individual investors have little experience with, but that plays an important role in the global economy and in advanced portfolio construction. The world of commodities. Chapter 9. Commodity investments. Commodities are the raw materials of civilization, oil that fuels transportation, gold that has served as a store of value for thousands of years, agricultural products that feed the world, industrial metals that build our infrastructure. These are the inputs that make the global economy function, and they have a unique place in the world of investing. Most individual investors have little direct exposure to commodities, and for good reason. Commodity markets are complex, often volatile, and difficult to access directly. But Ferri explains why understanding commodities and potentially including them in a portfolio can serve important purposes, particularly as a hedge against inflation. The most important thing to understand about commodities is how they relate to inflation. Commodities are physical things, and when inflation rises, the price of physical things tends to rise with it. When the cost of living is increasing rapidly, when the dollar's purchasing power is eroding, commodity prices often move higher. This creates a valuable counterbalance in a portfolio. When inflation eats away at the value of cash and hurts the real returns of bonds, commodities may be doing the opposite, rising in price alongside the general cost of things. Here is where most beginners make mistakes. They think of commodities as speculation, as casino bets on which way oil or gold prices will move. And frankly, for most individual investors approaching commodities through individual contracts or futures, that perception is not entirely wrong. Commodity speculation is genuinely risky and genuinely complex. But there are more measured, more portfolio-appropriate ways to gain commodity exposure. The first is through commodity-producing company stocks. If you own shares in a well-diversified energy company, a mining company, or an agricultural business, you gain indirect exposure to commodity prices through the performance of those businesses. When oil prices rise, energy companies tend to become more profitable. When gold prices rise, mining companies often see their share prices climb. The second is through commodity index funds or exchange-traded funds, which hold a diversified basket of commodity futures contracts across multiple categories of raw materials. These instruments give broad, diversified commodity exposure without requiring the investor to manage individual contracts. Gold deserves special mention because it occupies a unique psychological and historical role. For thousands of years, across virtually every culture and civilization, gold has been considered a store of value. It does not rot. It cannot be printed by a government. And during moments of financial panic, geopolitical crisis, or severe inflation, it has historically held or increased its value while other investments struggled. But Ferri is measured about gold. He does not treat it as an essential must-have for every portfolio. He treats it as a potential tool, particularly for investors who have genuine concerns about severe inflation or financial system instability. And he cautions that over very long periods, gold does not generate income and has had significant periods of poor real returns when adjusted for inflation. This is why this matters in real investing. Commodities are primarily a defensive and inflation hedging tool in a portfolio, not a primary growth engine. They shine brightest during specific economic conditions, particularly high inflation environments. During normal or deflationary periods, they often lag other asset classes significantly. If you are starting today, commodities are not an urgent priority if you are building your first portfolio. Establish your core stock and bond allocation first. Make sure you have adequate real estate exposure if appropriate. Only then consider whether a small commodity allocation makes sense for your specific situation and concerns. For most investors, a small allocation of 5 to 10% at most is appropriate if commodities are included at all. Imagine a survivalist who keeps a modest supply of food and water in their home, not because they expect a catastrophe tomorrow, but because they understand that extreme scenarios happen occasionally, and having that buffer costs relatively little and provides enormous peace of mind when the unlikely but possible occurs. A small commodity allocation in a portfolio works similarly. It is insurance against specific risks that other asset classes do not protect well against. The world of commodities reminds us that the global economy is not just abstract numbers on a screen. It is built on physical things, tangible resources, the raw material of human civilization. And a portfolio that acknowledges this physical dimension can be more resilient than one built entirely on financial instruments. We have now explored domestic stocks, bonds, cash, real estate, and commodities. But we have been thinking primarily about investments from a single country's perspective. And in a world that is increasingly interconnected, limiting your investment horizon to your home country means leaving an enormous portion of the global opportunity untouched. That brings us to one of the most important and most misunderstood chapters in building a truly diversified portfolio: international investments. Chapter 10: International Investments. Imagine the global economy as a vast ocean. The investments of your home country, whether that is the United States, the United Kingdom, Germany, India, or anywhere else, are just one section of that ocean. A significant section perhaps, but not the whole thing. When you invest only in the stock market of your own country, you are fishing in one part of the ocean and missing all the others. You are taking geographic concentration risk, betting everything on the economic performance of one nation. And while many countries have strong economies with long histories of investment returns, no single country dominates forever. Ferri makes a compelling case for international investing, and it comes down to three core arguments: diversification, opportunity, and reality. On diversification, different countries have different economic cycles. When one economy is slowing, another may be accelerating. When one market is expensive relative to historical valuations, another may be inexpensive. International stocks often have lower correlation with domestic stocks than domestic stocks have with each other. Adding them can genuinely reduce overall portfolio volatility. On opportunity, the United States, for example, is one of the world's largest and most sophisticated economies, but it is not the entire world economy. Many of the world's fastest-growing economies are in Asia, Latin America, and Africa. Many of the world's most innovative companies are headquartered outside the United States. Ignoring international markets means ignoring a large and diverse universe of investment opportunities. On reality, Ferri points out that most investors significantly overweight their home country's investments, a well-documented behavior called home country bias. This happens not for logical reasons, but for psychological ones. We trust what we know. We feel more comfortable with familiar companies and familiar markets. But familiarity is not a sound investment strategy. This is where most beginners make mistakes. They invest almost exclusively in their home country, believing it to be the best or safest choice, when in reality they are carrying a concentrated geographic risk they have not consciously chosen to take. International investments come in two broad categories: developed market investments and emerging market investments. Developed markets include countries with mature, well-established economies and financial systems. Think Western Europe, Japan, Australia, Canada. These markets offer relatively stable returns and well-regulated investment environments. They are not as exciting as emerging markets, but they are also not as volatile. Emerging markets include countries whose economies are growing rapidly, but that carry higher levels of political, regulatory, and currency risk. Think China, India, Brazil, Mexico, South Africa. These markets offer the potential for higher long-term growth, but with significantly more volatility and less predictability. A political crisis, a currency collapse, or a regulatory overhaul can dramatically affect returns in a single emerging market. Currency risk is an important concept for international investors to understand. When you invest in a foreign market, your returns are affected not just by how that market performs, but by how the exchange rate between your home currency and that foreign currency changes over time. A strong performance by a foreign stock market can be partially or even fully offset if that country's currency weakens relative to yours. This is not a reason to avoid international investing. Currency fluctuations tend to even out over long time periods, but it is a reason to understand what you are holding and to maintain a long-term perspective. Imagine an investor in a country whose domestic economy entered a decade of slow growth and stagnant markets. Their neighbors who had diversified internationally and held a mix of global investments experienced much better outcomes during that same decade, simply because other parts of the world were doing well during that time. If you are starting today, the most practical approach to international investing is through a broadly diversified international stock index fund. One fund can give you exposure to hundreds or thousands of companies across dozens of countries instantly. No research into individual foreign companies, no currency trading, no tracking of foreign regulations. Just broad, efficient, low-cost exposure to the global opportunity. How much of your stock allocation should be international? Opinions vary, but Ferri generally suggests that meaningful international exposure, perhaps 30 to 50% of your total stock allocation, is reasonable for most investors. Exactly how much depends on your home country's share of the global market and your own circumstances. The world is large, its economies are diverse, and its opportunities are spread across every continent. A truly global portfolio is not a luxury or an advanced concept. It is simply the most logical response to the reality of how the world economy actually works. We have now built our complete toolkit of asset classes: stocks for growth, bonds for stability, cash for safety, real estate for income and inflation protection, commodities for inflation hedging, and international investments for geographic diversification. The pieces are all in front of us. Now comes the most important practical skill of all: learning how to put those pieces together into a coherent, powerful, personalized portfolio. Welcome to Part 3. Chapter 11. Portfolio Construction. All the knowledge in the world about individual asset classes means very little if you cannot put them together into a coherent whole. Portfolio construction is where theory becomes reality. It is where the abstract concepts of diversification and risk management transform into actual decisions about where to put your actual money. Ferri frames portfolio construction as a process, not a single event. It is not something you do once and forget. It is a framework you establish thoughtfully and then tend to over time, adjusting it as your life changes and as you move closer to your goals. The construction process begins with a clear restatement of everything you already know about yourself. What are your financial goals? When do you need the money? How would you emotionally and financially handle a major market decline? These questions, which we explored in Part 1, now become the direct inputs for the actual architecture of your portfolio. Ferri recommends beginning with the broadest decisions first and moving toward specifics. The first decision is your overall stock-to-bond ratio. This single ratio, more than any other decision, determines the character of your entire portfolio: how it grows, how it behaves during downturns, how much it will fluctuate. A portfolio with 90% stocks and 10% bonds is aggressive. It will grow faster in good markets and fall further in bad ones. It is appropriate for very long time horizons and investors with high emotional tolerance for volatility. A portfolio with 60% stocks and 40% bonds is moderate. It offers solid long-term growth potential with meaningful cushioning during downturns. It is a classic allocation that has served many investors well over many decades. A portfolio with 30% stocks and 70% bonds is conservative. It prioritizes stability over growth. It is appropriate for shorter time horizons and investors who cannot afford or emotionally tolerate significant drawdowns. There is no universally right answer. The right stock-to-bond ratio is the one that aligns with your specific situation and that you can realistically maintain through market turbulence. This is where most beginners make mistakes. They build an aggressive portfolio when everything feels good, then abandon it at the first sign of serious decline. A portfolio you sell in a panic is worse than a conservative portfolio you hold through every storm. Once the overall stock-to-bond ratio is decided, the next step is subdividing within those categories. Within stocks, how much will go to domestic and how much to international? Within international, will you include only developed markets or also emerging markets? Within bonds, will you hold government bonds, corporate bonds, or a mix? What maturities will you target? These sub-decisions matter, but they matter less than the overall allocation. Ferri consistently reinforces the hierarchy. Get the big decisions right first. The small decisions will have much less impact on your overall outcome. Ferri also strongly advocates for using index funds rather than actively managed funds for each asset class in your portfolio. This is a theme he returns to throughout the book, and it is backed by a substantial body of research. The vast majority of actively managed funds underperform their benchmark index over long periods of time, after accounting for fees. By choosing index funds that simply hold all the securities in a given market, you ensure you capture the full return of each asset class without paying excessive fees to active managers who, statistically, are unlikely to beat their benchmarks consistently. Here is a real-world style example of portfolio construction in action. Imagine a 40-year-old professional with retirement 30 years away. They have a moderate to high-risk tolerance. They are comfortable with occasional large drops as long as the long-term trajectory is growth. A sensible portfolio for this person might look something like this: half in a domestic stock index fund, 1/4 in an international stock index fund, 1/5 in a diversified bond index fund, a small slice in a real estate index fund, and perhaps a small buffer in cash for near-term expenses. Together, these pieces cover all the major asset classes with broad diversification at low cost. If you are starting today, do not let the complexity of portfolio theory paralyze you. Start simple. A portfolio of 3 to 4 broadly diversified index funds covering domestic stocks, international stocks, and bonds can serve most investors extremely well. You can always add additional nuance and asset classes as your understanding and account size grow. The portfolio you build today will not be the portfolio you hold forever. Life changes. Goals change. Risk tolerance changes. And markets themselves change the composition of your portfolio over time, which is exactly why our next chapter is so important. Because once you build your portfolio, the work is not done. Markets will drift it away from your plan. And knowing how to bring it back in a disciplined and intelligent way is one of the most valuable skills you can develop as an investor. Chapter 12. Rebalancing Strategies. Over time, the different pieces of your portfolio will grow at different rates. Stocks might surge for a few years and come to represent a much larger portion of your portfolio than you originally intended. Bonds might lag and become a smaller piece. Left unattended, a portfolio that started as 60% stocks and 40% bonds might drift to 80% stocks and 20% bonds without you ever actively choosing to make that change. This drift is not neutral. It changes the risk profile of your portfolio in ways you did not intend and may not even notice until a sudden market downturn reveals that you were carrying far more risk than you were comfortable with. Rebalancing is the discipline of periodically reviewing your portfolio and making trades to bring it back to your target allocation. If stocks have grown too large, you trim stocks and add to bonds. If bonds have grown too large, you trim bonds and add to stocks. It sounds simple. In practice, it requires real emotional discipline. Here is where most beginners make mistakes. They find rebalancing deeply counterintuitive. It feels wrong to sell the investments that have been performing well and to put more money into the ones that have lagged. Human psychology pushes us toward doing the opposite, toward buying more of what is winning and abandoning what is losing. Rebalancing forces us to act against that instinct. But here is the insight that makes rebalancing click into place. By systematically trimming what has grown and adding to what has lagged, you are effectively implementing a disciplined buy low, sell high strategy. You are selling stocks after they have risen, when they may be relatively more expensive, and adding to bonds or other asset classes that have lagged, when they may be relatively cheaper. Over time, this disciplined process can modestly improve portfolio returns while simultaneously keeping risk in check. This is why this matters in real investing. Without rebalancing, even the most thoughtfully constructed portfolio will drift into a different risk profile than the one you designed. The investor who never rebalances may not realize how much additional risk they are carrying until a major market downturn arrives and their portfolio falls much further than they expected. Ferri discusses several approaches to rebalancing, and the right one depends on your situation. Calendar rebalancing means you check your portfolio on a set schedule, perhaps once or twice a year, and rebalance if the allocations have drifted meaningfully from your targets. This is simple, low effort, and effective for most investors. Threshold rebalancing means you rebalance whenever any asset class drifts by a certain percentage from its target, say 5 percentage points or more. This is more responsive to market movements, but may require more frequent action in volatile periods. A hybrid approach, where you check on a schedule and rebalance only if thresholds have been exceeded, combines the simplicity of calendar rebalancing with the responsiveness of threshold rebalancing. Many experienced investors favor this approach. There is also the question of tax efficiency and rebalancing, which Ferri addresses carefully. In taxable investment accounts, selling appreciated assets triggers capital gains taxes. This tax cost should be factored into your rebalancing decisions. In tax-advantaged accounts like retirement accounts, there are no immediate tax consequences to rebalancing, making it much simpler. One practical way to reduce the tax burden of rebalancing in taxable accounts is to use new contributions to bring your allocation back toward target. Rather than selling overweight assets, you direct new investments toward the underweight asset classes. This achieves the rebalancing effect without triggering taxable events. Imagine a captain who regularly checks their compass and adjusts course whenever the ship has drifted too far from the intended heading. They do not panic when the ship drifts. They correct calmly and methodically, knowing that regular small corrections keep the journey on track far better than waiting until the ship is dramatically off course and then making a massive, disruptive overcorrection. If you are starting today, choose a simple rebalancing approach and commit to it. Once a year, check your allocations against your targets. If any major category has drifted by more than 5 to 10% from your target, rebalance back. That single annual check, done consistently for decades, will do more for your long-term results than almost any other active investing decision you could make. Rebalancing is discipline made practical. And discipline, in investing, is everything. But even discipline cannot ignore the powerful reality of taxes. And the next chapter dives deep into one of the most overlooked and most impactful aspects of long-term wealth building: how to keep as much of your investment return as possible by investing in a tax-efficient way. Chapter 13. Tax-efficient investing. Here is a truth that many investors never fully grasp until they experience it firsthand. It is not just about how much your investments earn. It is about how much of those earnings you actually keep after taxes. Two investors can own exactly the same investment, earn exactly the same return before taxes, and end up with dramatically different amounts of wealth simply because one invested in a tax-efficient way and the other did not. Over decades, this difference can amount to many thousands, even hundreds of thousands of dollars. Ferri treats tax efficiency not as a minor detail, but as a fundamental dimension of portfolio management. Because every dollar you lose to unnecessary taxes is a dollar that will never compound and grow for you in the future. Let us start with the foundation of tax-efficient investing. The different types of accounts available to most investors. Tax-advantaged retirement accounts, such as traditional retirement savings accounts where contributions may be tax-deductible and growth is tax-deferred, allow your investments to grow without being taxed each year. You pay taxes only when you withdraw the money in retirement. This tax deferral is enormously powerful over long time horizons because your full return, before taxes, compounds year after year. Roth-style accounts, where contributions are made with after-tax money, but growth and withdrawals are tax-free, are even more powerful for younger investors or those who expect to be in a higher tax bracket in retirement. Your money grows completely tax-free, and you never pay taxes on the gains, no matter how large they become. Regular taxable investment accounts offer no special tax advantages, but they also impose no restrictions on withdrawals or contribution limits. They are essential for money you may need before retirement age. The key strategic principle that Ferri teaches is called asset location. This is the idea that where you hold different investments, not just which investments you hold, has a significant impact on your after-tax returns. The basic principle of asset location is to hold your least tax-efficient investments in your tax-advantaged accounts and your most tax-efficient investments in your taxable accounts. What makes an investment tax inefficient? Two main things: generating lots of taxable income in the form of dividends or interest, and generating lots of taxable capital gains distributions. Bonds, for example, generate regular interest income that is taxable as ordinary income at your highest tax rate. They are better held inside tax-advantaged accounts, where that interest grows tax-free. Real estate investment trusts generate large dividends, also better inside tax-advantaged accounts. High turnover actively managed stock funds that frequently buy and sell holdings generate lots of capital gains distributions, also better inside tax sheltered accounts. Broad market stock index funds, on the other hand, are naturally tax efficient. They generate low dividends, they rarely distribute capital gains because they trade infrequently, and their growth comes primarily through long-term price appreciation that is only taxed when you sell. These are well suited for taxable accounts. This is where most beginners make mistakes. They hold their highest income-generating investments in taxable accounts and their most tax-efficient investments inside retirement accounts, which is exactly backwards from the optimal strategy. Here is a real-world example. An investor holds a bond fund in their taxable account. Each year, the interest income is taxed at their ordinary income tax rate, which might be quite high. Meanwhile, their broad market stock index fund sits inside their retirement account where it generates no taxable events at all. By simply swapping these two holdings between accounts, this investor can reduce their annual tax bill meaningfully without changing a single underlying investment. Another powerful tax concept is tax loss harvesting. In taxable accounts, if one of your investments has fallen in value, you can sell it to realize a capital loss. That loss can be used to offset capital gains elsewhere in your portfolio, reducing your tax bill. You can then immediately reinvest the proceeds in a similar but not identical investment, maintaining your market exposure while capturing a tax benefit. If you are starting today, the simplest version of tax-efficient investing comes down to 3 steps. First, maximize contributions to tax-advantaged retirement accounts before investing in taxable accounts. Second, hold bonds and high-income investments inside your tax-advantaged accounts and broad stock index funds in taxable accounts. Third, be mindful of how frequently you trigger taxable events by trading unnecessarily. Picture a farmer who harvests crops with great skill, only to lose a large portion of the harvest to insects during transport. The solution is not necessarily to grow more crops. It is to protect the harvest that already exists. Tax-efficient investing is about protecting the harvest of your investment returns from unnecessary loss. Taxes are an unavoidable part of investing, but the difference between a well-structured tax strategy and a poorly structured one is enormous over a lifetime of investing. And nowhere does this matter more than during one of the most important financial transitions you will ever navigate. The journey into retirement. Chapter 14. Retirement Portfolios. Retirement is the destination that most long-term investors are working toward. But the moment you actually arrive at retirement is not the end of the investment journey. It is a new chapter with its own unique challenges, its own unique risks, and its own unique opportunities. Many investors spend decades thinking entirely about how to grow their portfolio. Then retirement arrives and they suddenly need to shift their thinking from accumulation to distribution, from building wealth to living on it. This transition is profound, and Ferri dedicates significant attention to it. The core challenge of a retirement portfolio is what financial planners call the sequence of returns risk. This is the danger that a major market downturn early in retirement, precisely when you are beginning to draw down your portfolio, can cause lasting damage to your financial security. Here is why this risk is so dangerous. During your working years, when you are contributing to your portfolio, a market crash is actually an opportunity to buy more investments at lower prices. But in retirement, when you are withdrawing from your portfolio each month to pay bills, a crash forces you to sell investments at low prices. And every dollar you sell at a low price is a dollar that will never recover and grow for you in the future. This sequencing problem means that the first decade of retirement is particularly critical. Two investors can experience the exact same average annual return over a 30-year retirement, but end up with dramatically different outcomes depending on when the good years and the bad years occurred. The investor who experienced strong returns early in retirement and poor returns later did much better than the investor who experienced the same returns in reverse order. This is where most beginners make mistakes in retirement planning. They think the accumulation strategy that served them well for decades will automatically work in retirement too. But in retirement, the math works differently, the risks are different, and the strategy must adapt accordingly. Ferri discusses several approaches to managing a retirement portfolio sustainably over what might be a very long retirement. Modern retirement can last 30 or even 40 years, which means retirement portfolios still need significant growth assets, particularly stocks, even after the transition from work to retirement. One widely used framework is the bucket strategy. This approach divides a retirement portfolio into three separate mental buckets based on when the money will be needed. The first bucket holds 1 to 3 years of living expenses in cash or very short-term stable investments. This bucket covers immediate needs and provides a buffer so that if markets fall, you are drawing from this stable bucket rather than selling fallen stocks. The second bucket holds 3 to 10 years of future spending needs in somewhat more growth-oriented but still relatively conservative investments, perhaps a blend of bonds and balanced funds. This bucket refills the first bucket as it is drawn down. The third bucket holds everything beyond 10 years in a growth-oriented portfolio of broadly diversified stocks. This bucket has time to recover from market downturns and continues growing to fund the later stages of retirement. The psychological power of the bucket strategy is significant. When markets fall sharply, a retiree using this approach can see clearly that their immediate spending needs are covered by the stable first bucket. They do not need to sell anything during the downturn. They can let the third bucket recover without touching it. Withdrawal rates also matter enormously in retirement planning. Ferri discusses the research around sustainable withdrawal rates, the percentage of your portfolio you can withdraw each year without running the serious risk of outliving your money. Drawing too little leaves you unnecessarily constrained. Drawing too much risks, depleting the portfolio before the end of retirement. This is why this matters in real investing. A retirement portfolio is not just about having enough money. It is about having enough money in the right structure, drawn down at the right pace, to sustain your lifestyle for decades without major disruption or the need for drastic course corrections along the way. If you are approaching retirement today, begin shifting your focus from maximizing returns to managing risk and creating sustainable income. This does not mean becoming ultra-conservative. It means being strategic. Maintaining enough growth assets to support a long retirement while maintaining enough stability to weather the early years without panic selling. Picture a long-distance runner crossing a finish line. The race is not over. They have a long cool-down walk ahead of them. And how they manage the transition from running to walking, how they catch their breath, pace themselves, and recover intelligently determines how well they feel and function for everything that comes next. Retirement is the finish line of one race and the beginning of another. And the habits, the discipline, the portfolio structure you build before and after that line will determine the quality of what follows. Having explored how to build and manage a portfolio throughout the full arc of your investing life, there is one final practical tool that Ferri offers to help investors see real-world examples of how all these principles come together in practice. Model portfolios. Chapter 15. Model portfolios. At a certain point, all the theory and all the principles need to translate into actual numbers. Real allocations, specific funds, a concrete plan you can actually implement with your actual money. That is what model portfolios are for. Ferri presents model portfolios not as rigid templates to be followed exactly, but as illustrations of how the principles discussed throughout the book can be assembled into real investment plans for different types of investors. They are starting points, designed to spark intelligent customization rather than mindless copying. The key insight behind model portfolios is that most investors do not need complex solutions. The financial industry often makes investing seem far more complicated than it needs to be, in part because complexity creates the impression that professional management is necessary. But the reality, backed by decades of research, is that a simple, low-cost, well-diversified portfolio built from a small number of index funds will outperform most actively managed alternatives over long time horizons. Ferri presents models organized around risk tolerance and time horizon, the two primary variables that determine what an appropriate portfolio looks like for any given investor. An aggressive model for a young investor with a very long time horizon and high risk tolerance might be weighted heavily toward global stocks, with a smaller allocation to bonds and a small slice of real estate. The stock component would include both domestic and international holdings, providing broad geographic diversification. The bond component would be modest but present, providing some stability without sacrificing the growth potential that a long runway allows for. A moderate model for a middle-stage investor, perhaps 10 to 20 years from retirement, would shift toward a more balanced approach. a meaningful but still majority stock allocation, with a significantly larger bond component than the aggressive model. This investor still needs growth but must increasingly protect what they have built. A conservative model for an investor near or in retirement would hold a larger allocation to bonds and stable assets, with a smaller but still meaningful stock allocation to provide long-term growth against inflation. The exact proportions would depend on whether the investor has a pension or other guaranteed income sources that reduce their dependence on portfolio withdrawals. This is where most beginners make mistakes. They either copy a model portfolio without ensuring it actually fits their specific situation, or they never create a coherent portfolio at all, leaving their money scattered in random investments without intentional structure. If you are starting today, use model portfolios as a framework, not a prescription. Start by identifying which general category describes you: long horizon aggressive, medium horizon moderate, or short horizon conservative. Then build a simple version using broadly diversified index funds, adjusting proportions based on your own circumstances, tax situation, and emotional tolerance for risk. Here is a real-world style example. A 28-year-old who just started their first full-time job looks at the aggressive model portfolio and decides it fits their 35-year time horizon and their high comfort with risk. They open a retirement account, select a domestic stock index fund for half of their contributions, an international stock index fund for about a third, a bond index fund for the remainder, and set up automatic contributions from every paycheck. They set a calendar reminder to check their allocations once a year. Then they get back to living their life. Simple, consistent, powerful. What makes model portfolios genuinely valuable is not any single allocation they recommend. It is the thinking they represent. Every asset class is there for a reason. Every proportion reflects a deliberate trade-off between risk and return. Every fund choice prioritizes low cost and broad diversification over complexity and speculation. Ferri also emphasizes that the best model portfolio is the one you can actually stick with. A portfolio that is theoretically optimal but that causes you so much anxiety during market downturns that you sell everything is far worse than a slightly more conservative portfolio that you hold through every storm. As we close part 3 and move into the final section of this journey, we leave behind the tactical and practical and move into something more profound. The hidden forces that sabotage even the best investment plans, the psychological, behavioral, and emotional challenges that separate investors who succeed from those who fail, not because of what they know, but because of how they think and feel. Chapter 16. Behavioral Issues in Investing. Every investor faces two markets: the external market of stock prices and economic cycles, and the internal market of their own emotions, biases, and psychological patterns. The external market can be understood and navigated with knowledge. The internal market is far harder to manage because its forces operate quietly, often invisibly, shaping decisions in ways we do not even recognize. Behavioral finance is the field that studies how human psychology affects investment decisions, and the findings of this field are both fascinating and sobering. We are not the rational, data-driven decision-makers we imagine ourselves to be. We are emotional creatures who feel losses far more intensely than equivalent gains, who are far more influenced by recent events than by long-term history, and who consistently make predictable, costly mistakes as a result. Ferri dedicates a full chapter to these behavioral issues because he understands something important. You can have perfect knowledge of asset classes, portfolio construction, and rebalancing strategies and still destroy your own investment results through emotional decision-making. Behavior is the wild card that determines whether good investment knowledge actually translates into good investment outcomes. Let us explore the most common and most costly behavioral mistakes that investors make. The first is loss aversion. Research consistently shows that the pain of losing a certain amount of money is roughly twice as powerful psychologically as the pleasure of gaining the same amount. This asymmetry means that when portfolios fall, the emotional pain is intense and often drives investors to make panicked decisions they would never make with a clear head. Selling at a loss to stop the pain, then missing the recovery, is one of the most common and most costly expressions of loss aversion. This is where most beginners make mistakes. They think their emotional reactions are rational responses to real information. But often, the feeling that you must sell right now because markets are falling is not information. It is emotion. And acting on that emotion is almost always the wrong financial decision. The second major behavioral trap is recency bias. We dramatically overweight recent experience when thinking about the future. After a long bull market where stocks have been rising for years, investors tend to believe that stocks will continue rising. After a sharp crash, they tend to believe that more pain is coming. Both beliefs distort rational decision-making by treating the recent past as a reliable guide to the near future, when in reality markets are far more random and mean-reverting than they feel in the moment. Imagine an investor in late 2021 who saw stock markets near all-time highs and could not imagine them falling meaningfully. Or an investor in early 2009 who saw the wreckage of the financial crisis and could not imagine any recovery. Both were experiencing recency bias. Both were likely to make suboptimal decisions as a result. The third behavioral trap is overconfidence. Studies consistently show that most investors believe they are above average in their investment abilities, which is statistically impossible for a majority. Overconfident investors trade too frequently, take excessive risks, and believe they can pick winning stocks in time markets in ways that the evidence says very few people can do consistently. The fourth is herd behavior. When everyone around us is buying something excitedly, our instinct is to join in. When everyone is selling in panic, our instinct is to sell too. But the herd consistently buys near peaks and sells near troughs. Following the herd is a reliable way to get the exact opposite of good investment timing. The fifth, and perhaps the most subtle, is confirmation bias. We unconsciously seek out information that confirms our existing beliefs and dismiss information that contradicts them. An investor who believes a particular stock is a winner will notice all the positive news about that company and overlook the warning signs. This selective processing of information leads to blind spots that can be financially costly. So what is the solution? Ferri offers several powerful antidotes to behavioral mistakes. The first is a written investment policy statement. Before investing, write down your goals, your target asset allocation, your rebalancing triggers, and your plan for how you will behave during market downturns. When emotion strikes during a crash, this document becomes your rational anchor, a reminder of what you decided to do when you were thinking clearly. The second is automating as many decisions as possible. Automatic contributions, automatic rebalancing where available, and pre-committed withdrawal strategies all reduce the number of opportunities for emotional interference. The third is deliberately limiting how often you check your portfolio. The more frequently you look at your portfolio's day-to-day movements, the more emotional noise you are exposed to, and the more temptation you face to react to that noise. For long-term investors, checking once or twice a year is genuinely sufficient and far healthier psychologically. If you are starting today, the most important behavioral commitment you can make is this. Write down your investment plan. Write down your reaction plan for market downturns. And commit in advance that you will not make major changes to your portfolio in response to short-term market movements or headline news. Picture a surgeon who has a protocol for every procedure. When things go unexpectedly during surgery, they do not improvise wildly based on emotion. They follow the protocol, make measured adjustments, and stay calm under pressure. Successful investors treat their investment plan the same way. The protocol exists precisely for the moments when emotion wants to take over. Understanding our own psychological tendencies is one of the most valuable gifts this chapter offers. Because markets will always be uncertain, volatile, and occasionally terrifying. What changes when you understand your own biases is not the market. It is you, and that change in you is worth more than any market timing strategy or stock picking skill could ever provide. As we move forward, we turn to one of the practical tools that has revolutionized how individual investors build and manage portfolios. A tool that has made low-cost, broadly diversified investing accessible to virtually anyone with any amount of money. Exchange-traded funds and index funds. Chapter 17. Exchange-traded funds and index funds. If asset allocation is the strategy, then index funds and exchange-traded funds are the most powerful tools for implementing that strategy in the real world. They are the instruments that make the principles of low-cost, broadly diversified, passive investing accessible to absolutely anyone. Let us start by understanding what these two instruments actually are and how they relate to each other. An index fund is a type of investment fund that aims to track the performance of a specific market index rather than trying to beat it. A market index is simply a defined list of securities representing a particular market segment. A broad domestic stock market index, for example, might include thousands of companies across all sectors of the economy. An index fund that tracks this index simply holds all those companies in proportion to their market size, without any active management trying to pick winners and losers. An exchange-traded fund, or ETF, is a specific structure for holding an investment fund. Like traditional index funds, most ETFs track a specific index. But unlike traditional mutual funds, ETFs trade on stock exchanges throughout the day like individual stocks. You can buy or sell them at any moment during market hours at the current market price. This trading flexibility, combined with their typically very low-cost structure, has made ETFs one of the most popular investment vehicles of the past 2 decades. But the real power of both index funds and ETFs, whether traditional mutual fund format or ETF format, is not the structure. It is the philosophy they embody. The philosophy of passive investing. Passive investing says this: rather than trying to outperform the market through active stock selection or market timing, simply own the market itself. Accept market returns. Minimize costs, and let time and compounding do the work. This approach is not exciting. It does not make for great dinner party conversation. There is no story of brilliant insight, no narrative of identifying the next great company before anyone else. But the evidence in its favor is overwhelming. Here is why this matters in real investing. Research consistently shows that the vast majority of actively managed funds, those run by professional managers trying to pick winning stocks and beat their benchmark index, fail to do so over long periods after accounting for their fees, and the ones that do outperform in any given period rarely sustain that outperformance in subsequent periods. The mathematics of why this happens are not complicated. Every investor in aggregate earns the market return before costs. After costs, the average active investor must earn less than the market return because they paid higher fees. Index funds, with their dramatically lower costs, capture more of the market's return and deliver it to investors. Over decades, this cost advantage compounds into an enormous difference in wealth. Consider two investors over a 30-year period. Both earn the same gross return from the market. One pays 1% per year in fund fees through an actively managed fund. The other pays 0.1% per year through an index fund. The difference of 0.9% per year seems tiny. But over 30 years of compounding, the index fund investor ends up with significantly more wealth, sometimes tens of percent more, simply because more of their return stayed with them rather than going to fund managers. This is where most beginners make mistakes. They assume that higher-priced funds must deliver higher performance to justify their cost. But the evidence says the opposite is true. In investing, higher cost is typically associated with lower net return, not higher. Ferri also addresses a common misconception about index investing. Some people believe that if everyone indexed, markets would become inefficient because no one would be doing the price discovery work of researching individual companies. But in practice, even with the dramatic growth of index investing over the past decades, active managers continue to exist in large numbers and continue to do the work of setting prices through their research and trading. Index investors are free riders on this price discovery process, and it is perfectly logical and ethical to be one. There are now index funds and ETFs covering virtually every asset class and every market segment imaginable. Domestic stocks, international stocks, bonds of every type and maturity, real estate, commodities, specific sectors, specific countries, specific themes. The toolkit available to a self-directed investor today is more powerful and more cost-effective than anything available to institutional investors a generation ago. If you are starting today, the most important practical step is to choose a low-cost brokerage or investment platform that offers a wide selection of index funds and ETFs, and to begin building your portfolio from those building blocks. Compare expense ratios, which are the annual fees charged by a fund as a percentage of your investment. For broad market index funds, Expense ratios can be extraordinarily low, sometimes a small fraction of 1% per year. That low cost is one of the most valuable features any investment can offer. Picture a craftsman who has access to both crude, expensive tools and precision, affordable instruments. Both can technically accomplish the task. But the precision, affordable instruments produce better results with less waste. Index funds are the precision instruments of the investment world. We are now approaching the final chapter of this journey. We have learned how to build a portfolio, how to rebalance it, how to invest tax efficiently, how to manage it through retirement, and how to use the best available tools. The final piece is the ongoing work of monitoring and maintaining what you have built, not obsessively, not anxiously, but thoughtfully and consistently. Chapter 18. Monitoring and maintaining your portfolio. Building a great portfolio is an achievement, but a portfolio that is built and then never tended will drift away from your intentions, accumulate unnecessary risk, and eventually stop serving the goals it was designed to meet. Maintenance is not glamorous work. It is not exciting, but it is essential. The good news is that maintaining a well-built index fund portfolio requires far less time and effort than most investors expect. You are not a stock picker who must continuously research companies and react to earnings reports. You are not a market timer who must predict economic cycles. You are a long-term investor with a clear plan, and your job is simply to keep that plan on track. Ferri outlines what a realistic monitoring routine looks like for a thoughtful long-term investor. First, and most important, review your target allocation at least once a year. Compare where your portfolio actually is to where your plan says it should be. If any asset class has drifted significantly from its target, take note. If the drift has exceeded your rebalancing threshold, rebalance back to target. If not, make a note and check again in 6 months. This review does not need to take more than 30 to 60 minutes once or twice a year for most investors. Second, assess whether your target allocation itself still makes sense for your current life situation. Have your goals changed? Has your time horizon shortened? Has your income or financial situation shifted meaningfully? A promotion, a job loss, a new family member, an inheritance, or a health change might all warrant reconsidering your overall allocation. The target allocation you set at 30 should probably look different at 50. Third, review the costs of your investments. Are you still holding the lowest cost version of each fund that meets your needs? Fund fees have generally declined dramatically over the past decade, and periodically checking whether lower-cost alternatives have become available in your asset class can save meaningful money over time. Fourth, resist the urge to react to market news and economic headlines. This is perhaps the most difficult monitoring discipline of all. When you review your portfolio during a turbulent market period, the temptation to make changes based on what you see in the news is powerful. But unless the news has actually changed your long-term goals or time horizon, it should not change your portfolio. Markets fluctuate constantly. Your plan should not. This is where most beginners make mistakes. They conflate checking their portfolio with managing their portfolio. These are not the same activity. Checking means looking at your allocation and comparing it to your plan. Managing means making deliberate, plan-driven adjustments. Reacting means making emotional, news-driven changes. Only the first two are appropriate. The third is destructive. Here is a real-world scenario. An investor who built a diversified portfolio 5 years ago has been reviewing it annually since. One year, during a significant market downturn, they check their portfolio and see that it has dropped substantially. The stock portion has fallen much further than the bond portion, meaning the portfolio has drifted away from its target. The bond allocation is now larger than planned relative to stocks. Counterintuitively, the disciplined action here is to rebalance by adding to stocks, the investment that just fell. This is emotionally difficult because stocks feel dangerous right now. But the plan says they are underweight relative to target. And every historical precedent says that adding to broad market investments during downturns, rather than retreating from them, has been the path to better long-term returns. The investor who follows their plan in this moment is acting with genuine financial intelligence. The investor who sells stocks at the bottom because it feels frightening is acting with emotion that is masquerading as intelligence. Ferri also addresses what to do as you approach major life milestones. The years approaching retirement, for example, are not the time for dramatic portfolio overhauls. They are the time for gradual, deliberate shifts. If you have planned your transition well, moving from a growth-oriented portfolio to a more balanced one is a smooth process done in small steps over years, not a sudden panic-driven restructuring done overnight. If you are starting today, set up a simple monitoring calendar. One dedicated portfolio review per year, perhaps tied to a date you will remember. Use that review to check three things: allocation versus target, life circumstances versus plan assumptions, fund costs versus best available alternatives. Write down what you see and what, if anything, you are changing and why. This rec don't say health and run your physics storm. There is a learning tip and stay off the well. That is how Mars the thing now you are is my house that is with all from the plan element. This what the term so you is a hard we go couldn't from dissertation like every chance through the hand for you through the stars and now right with that thing sounds immersive after the sequence all wants to kings of a right and things with us and was simple it's right is there not they won't take is not and England for the people and all is them potential word action and bring interpretation and main the church or calculation recently done is costable solves where it's to be on a drivable not so them under but always when in a way for best real fire not to pour it's good and through that and everyone convert he has to day and a half to painting a vibe or design reasonable and more always cut not for ever feel but in won't have certain your significant lead or will listen you need them to temperature do it more older or from channels to be more than one nation city more in your sort of proposals you can to a good concert and you all the asking like you not call search and over that plus just to halfway point out of it you fit add with a low or instance not stating that the station say